Hi, Tony DeWitt here, Missouri appellate attorney and a guy who likes to make the law make sense on YouTube. What happens when your insurance carrier runs out of money to pay claims? I know what you're thinking. That never happens. But it does. Take a look at the companies here that have gone into receivership in the last few years. This is from a trade industry group of insurance companies, and if you look at this, you can see all of the different insurers that have gone belly up in the last few years. Now, if you see an asterisk over to the side, that means the company was able to be rehabilitated. In other words, get back into the situation where it could pay claims and be profitable again. But there are very few of those on this list. Each of these companies has failed and gone into receivership. And that's a cautionary tale because one of your insurance companies could just as easily get onto this particular list. Now let's look at some of the reasons why those folks may have gone into receivership. One of the reasons that frequently is the case is bad investments. Now, you might think that when you pay your premiums, they just stick your premiums in the bank and they wait for a claim to arise and then they pull money out of your premiums. But that's not what happens. An insurance company, when it sets itself up, has to establish reserves. And reserves are the amount of money that they hold back and don't spend on anything else other than to pay claims. And whenever a claim comes into an insurance company, the first thing the adjuster does is they set reserves on that particular claim. And that's how they know what liabilities they have or potential liabilities they have going forward. Sometimes, however, they screw up on those reserves, and I'll talk about that in a moment. But what they do with the amount of money that they hold back is they invest it. Now, normally they will invest it in something like a hedge fund that pays a return and generates some cash flow for them, or they'll invest it in money market securities, that sort of thing. They will do whatever kind of investment they need to do to produce the cash flow that they need to meet their responsibilities to their insurers. At the end of the year, when they tally up everything, they take the premiums that they've earned at that point, they put those into their reserves, and then they do a rough calculation to determine whether or not they are profitable. Now, some companies are mutual insurance companies where the individuals who are insured through that company benefit if the company has a good year. State Farm is one of those insurance companies that's a mutual, even though you're supposed to pay $900 a year for your house insurance through State Farm. If they have a particularly good year, you may find that the next year that $900 becomes $850, something like that. When they have a good year, they take care of their mutual insureds. And there are a lot of companies that are like that are mutual insurance companies that sort of credit back some of the profit that they make to the individuals who have purchased their insurance. But for the most part, when an insurance company makes investments, they make it in the stock market, so they are particularly vulnerable to market downturns. And one of the things that happens when the market goes south is that the cash flow starts drying up and they are unable to meet day-to-day responsibilities without dipping into those reserves. And as long as the reserves that they retain are greater than the claims that they have made reserves for, they're in good shape. But to give you an example, you have a situation where they determine that their insured is not at fault in a car accident, so they set the reserves at $5,000 because that's roughly what they pay when they want to buy somebody off. But as facts develop, it turns out that their insured is at fault and he gets hit with a $300,000 judgment. Well, now they have to adjust their reserves, and that is not a good thing for them. When a situation develops where you have bad investments, market downturns, and natural disasters like Hurricane Katrina being one, Hurricane Charlie being the other. When you have those natural disasters and all of the other things sort of coming together at once, it's fairly easy for an insurance company to fail. Now, often insurance companies take out insurance. I know that sounds silly, but it's true. It's called reinsurance. And they'll go to a reinsurer and they'll say, we have a lot of property along the Gulf Coast that is subject to hurricanes, and we would like to set off the amount of money, amount of potential liability, and we'll buy reinsurance for it. And then, of course, if the reinsurer goes bad, that can take down multiple different companies. But the bottom line is that insurance companies normally try to generate their profits and maintain solvency through good investments and through good underwriting, meaning the risks that they choose to insure. For example, USAA initially insured only military officers because they felt like they were more responsible, I suppose. The risks that they determine to insure, that determines in large part whether or not they're going to be successful as an insurance company. When they are not, that is when things get really ugly. Sometimes a large verdict will come in, a $30 or $40 million claim that they just don't have the ability to pay, and they have to go into receivership. Now, every state has a Department of Insurance. Sometimes they're called the Director of Insurance or the Insurance Department, something like that, that regulates insurers in their state. Now, just because an insurance company sets up in a particular state doesn't mean they can only write in that state. For example, State Farm and American Family Insurance and USAA write in many different states. And as a result of that, because they write in those different states, they have to be responsible to the insurance laws in those states. And that creates a lot of work for them, and they wind up with a lot of people on their payroll to make sure that they are complying with all of those state laws. Well, when they get themselves into a pickle and they can't, pay their way out of it, then they go into receivership. Now, the receivership process is usually run by the Department of Insurance, although in some somewhat extreme cases, insurance departments will appoint an independent receiver, meaning a law firm or an accounting firm, most often an accounting firm, to go through and handle the winding up of the business of an insurance company. First thing they do is they cancel all of the policies, and then they solicit claims for all of the potential policies, all the potential liability that their insureds may have had. The other thing they do is they gather up all of the reserves and all of the accounts payable, all of the things where money is coming in to the company, and that includes premiums and that sort of thing. They put that into a fund, and then they solicit claims from the public, meaning if you have a claim against Acme Insurance Company and Acme's in receivership, you make that claim to the Department of Insurance, to the receivers in the Department of Insurance. Now, let's say you have an auto accident claim. You were hit from behind by one of their insureds. Well, you tally up the amount of damages that your insurance company paid along with your deductible, and that becomes the amount that they are responsible to pay. And let's suppose you had a property damage claim. You were insured through Acme Insurance, and they wrote a homeowner's policy, and a tree fell in your front room, and it smash that side of your house, and it's going to cost, $50,000 to get your house repaired. That's a property damage claim that they now can't pay, so you submit that to the Director of Insurance. It sometimes takes a year or more for all of the claims to come in because of the way the policies were written. Not all policies require that claims be made in a timely manner, but most do. And so one of the things that the Department of Insurance and the receivers will do is they will demand strict compliance with the terms of the policy. So after they solicit and get all of the claims from all of the people who may have claims against that insurer, they then determine which claims to allow and which claims to disallow. And if you did not comply with the terms of the policy, if you didn't work through and honor the cooperation clause, for example, or if there was an intended accident or an intended injury, your neighbor came over and called you a bad name and you punched him in the nose and he sued you, well, then you're probably not going to get your claim allowed. But once the claims are all allowed, then the next step is for the insurance department to prioritize those claims. Now, prioritization means essentially that there are some people who are certain to get paid, and then the further down the list of priorities you go, the less likely it is that you're going to get your insurance claim paid. So, what are those priorities? Well, generally, and using the state of Illinois as a model, the first and most important level of priority is the costs and expenses of administration. So if the State Department of Insurance has to go out and contract with auditors and claims adjusters and that sort of thing, then the costs of getting all of these claims together, which would ordinarily be borne by the insurance company, become the costs and expenses of administration. So the state has its hand out at the very beginning saying you got to pay the state first before anybody else gets paid. The next level of priority is for tax liens. Now, state taxes, you could have state payroll taxes, state income taxes, state taxes on property, any of these things where a lien has been asserted against either the insurance company or a client, those tax liens are paid next. Then, because an insurance company can't operate without having some cooperation from the staff, the insurance department will pay the payroll costs up to $1,000 per individual for employees who had claims against the insurance company and didn't get paid by the insurer. Now, if you're making $6,000 a month as, a high-level executive in the insurance department, you're only going to get $1,000, and the $5,000 that you are owed for that month, that's going to come later on as a general creditor, and you may or may not get that money. And then the fourth level of priority are for insurance claims against the insurance company for property damages, personal injury damages, that sort of thing. So somebody who is a victim, whose car was run into or whose house was destroyed by a fire or a flood, all of those kinds of insurance claims come in and they get paid next, assuming, of course, that they have been allowed. And then after that, state and federal lien taxes without any liens, so state and federal taxes without any liens are paid, and then general creditors being people like, for example, Office Depot, who sold them $10,000 in supplies and didn't get paid up front, which is kind of silly, but a lot of times, particularly suppliers who supply on a routine basis will have an arrangement where they submit an invoice and they get paid within 30 days. And their cash flow is sort of dependent on that. And you can wind up with a big insurer having a huge impact on its local economy if it goes into receivership. Several years ago, when I lived in Connecticut, where the Hartford Insurance Company was, they had massive layoffs because the company had run into a bit of a financial snag, and it had a lot of trickle-down effects in the community. So that's what happens when an insurance company winds up going into receivership. Eventually, many of the claims are going to be paid, but each one of those priority levels are paid in full first. So the costs and expenses of administration paid in full up front at the very beginning. Then the tax liens, those are paid in full. Then the payroll, that's paid in full. Then the insurance claims, that's paid in full if it can be paid in full. And if it can't, then if there are 100 claimants and $1,000 in just to keep the math simple, then pretty much everybody is going to get $10. That's, you might get 10 cents on the dollar for your claims if there's not enough money to pay all of those claims. And of course, if you're a general creditor and they run out of money paying all those claims, you aren't going to get anything from them. That's how it works in an insurance receivership. And it really is designed to protect people who have insurance claims. It doesn't sound that way by virtue of making them the fourth priority, but it actually is designed to protect them. And that's a good thing because insurance is designed to protect the victims. The reason you buy car insurance maybe for your personal belief, you may want to have car insurance to protect you in the event you have an accident and you want to get your car repaired. But the primary purpose and the reason why states mandate it is to make sure that injured victims get taken care of. That's the public policy of the state. And so, for that reason, in many cases, I think there's only 2 states that don't mandate liability insurance, and each state has a liability minimum. You have to get insurance that will be able to pay at least $25,000 or $50,000 in costs or expenses. And so the reason they do that is to protect the motoring public. Well, that's probably a lot more about failing insurance companies than you ever wanted to know, but sometimes it's helpful to know this kind of thing and adjust your expectations appropriately. One thing you absolutely can and should do is from time to time check the AM Best guide for your insurance company and find out how they're rated. They have an A, B, C sort of rating system for different insurance companies, and you want to be with an A or an A plus company, particularly when there is a market downturn or you're in a period of high inflation, because those are the times when it's most likely that an insurance company will fail. And if you look on there and you find that your car insurer is a C-rated insurance company, it might be time to pay a little bit more and go to a different company to get a better policy and perhaps ensure that you are not going to be in a situation where you have to depend on the Department of Insurance. That's what I have for you today. If you have the opportunity today, do something nice for somebody. Go out of your way, open a door, whatever it is, do something nice for somebody. It'll make your day better. Have a terrific day. Catch me down here at the beach next time. If you like this video, here are a few others you might try, and don't forget to subscribe. Have a terrific day, guys.